Volume analysis doesn't require the volume to be perfectly accurate. When looking at the volume histogram, we're looking to see if volume is unusually high or low. Because this is all we're looking for, we don't need super precise figures. Volume represents activity. We're looking for the activity or inactivity of institutional traders. When volume is extraordinarily high, we can assume that the professional side of the market is active, and when volume is exceptionally low, we can assume that the institutionals are inactive. Because professional traders have no choice but to sell into rallies and to buy drops in price, we look for weakness to appear on widespread up bars with exceptionally high volume, and for strength to appear on widespread down bars with exceptionally high volume. Volume analysis is most valid when combined with supply and demand zones, as this is where there may be outstanding orders in the market, and it's also where other traders will be looking to take a position. I tend to enter my positions before I get a volume entry based on sentiment, supply, demand, and correlations as covered in previous videos, but I'll still use volume analysis to monitor my trade and determine my exits. The first thing that you want to do when you're looking for a volume trade is identify higher time frame supply and demand zones. In this example, I've highlighted a higher time frame supply zone. After we've gotten that taken care of, we drop to a smaller time frame. So for example, you might want to identify your supply and demand zones on the 4-hour and then drop to the 15-minute to start looking for entries. So let's pretend that red zone is a 4-hour supply zone and this is a 15-minute widespread up bar closing off the highs. A widespread up bar is an opportunity for professional traders to sell, as the size of their trades is so large that they need lots of people to be on the other side of their trade. Because high volume tells you that the professional side of the market is active and price is rising, it's reasonable to assume that the pros are selling. For the most part, pros don't buy after a large rise in price into a supply zone, so when you see that the pros are active and price is rising into a supply zone, it probably means that they're selling. This isn't always the case, but we'll cover that later. The next thing you want to do is wait for an upthrust. These are bars that are usually into fresh high ground, right into a supply zone and on high volume. Upthrusts are typically characterized by long rejection wicks with a close towards the low of that bar. This represents market makers marking price up to fill more short positions and catch stops before the move down. They're just trying to shake out the weak holders. After this has happened, the traditional VSA entry is going to be on the break of the low of a no demand bar. A no demand bar is a small, low volume up bar. When the volume of an up bar is exceptionally low in context of the higher time frame supply zone and the two bars mentioned previously, chances are the market is not interested in that move. The narrow spread means that there's not a lot of force behind it, and the low volume means that the professionals are not participating in that move. This sends a signal to all volume traders that there's not a lot of interest in moving price up at that point. Traditional VSA traders will enter on the break of the low of that bar. When you're dealing with a demand zone, it's the exact opposite. Let's say that this green zone is a 4-hour demand zone, and this is a 15-minute widespread down bar closing off the lows. A widespread down bar is an opportunity for professional traders to buy, as the size of their trades is so large that they need a lot of people on the other side of their trade. Because the high volume tells you that the professional side of the market is active and price is dropping, it's reasonable to assume that the pros are buying. For the most part, pros don't sell after a large drop in price into a demand zone. So when you see that the pros are active and price is falling into a demand zone, it probably means that they're buying. This isn't always the case, but we'll cover that later. Next, it's time to wait for a shakeout. A shakeout is the opposite of an upthrust. Shakeouts are typically characterized by long rejection wicks with a close towards the high of the bar. This represents market makers marking price down to fill more of their long positions by catching bull stops before the move up. They're just trying to shake out the weak holders. You can take an aggressive entry on the shakeout to get better risk or reward, but you have to be careful with moving your stop to break even because price may come back to that zone for further accumulation. The more conservative VSA entry is going to be on the break of the high of a no supply bar, which is the exact opposite of a no demand bar. A no supply bar is a narrow spread down bar in low volume. It shows that the pros are not interested in lower prices. Low volume is defined as volume less than the previous two. The good thing about waiting for this entry is that when you're right, you can get your stop to break even pretty quickly. as most of the accumulation is already taking place. This is the trade-off for missing out on some of the risk-reward that you achieve by taking aggressive entries in the zone. When you take an aggressive entry in the zone, you should wait a little longer before moving your stop to break even, because there could be further accumulation that needs to take place before price can make its move up.